Sanctions don't just punish countries, they force them to redesign their entire supply chains. Economic sanctions are reshaping global trade flows. From energy to semiconductors, sanctioned countries are adapting fast. It's more than just a headline. It's a massive shockwave that forces entire nations to completely rethink how they trade, who they trust, and where they get their essential goods. How these powerful political tools are reshaping the global economic map, creating new winners, new losers, and a whole new set of rules for the 21st century. So, what are modern sanctions really about? Forget the old idea of just blocking a few ships. Today's sanctions are surgical and incredibly sophisticated. They target the very heart of a country's economy, its financial system, its access to high-tech components, and its logistical networks. Think about it: cutting a country off from the SWIFT international payment system is like taking away its global credit card. It can't easily buy or sell anything. Similarly, restricting access to crucial technology, like advanced semiconductors, can paralyze entire industries, from car manufacturing to consumer electronics. And let's not forget logistics. Sanctioning shipping companies or closing off airspace effectively isolates a country, making it incredibly difficult and expensive to move goods in or out. These aren't just minor inconveniences. They're designed to apply maximum pressure by disrupting the fundamental mechanics of a modern economy. The immediate fallout from these sanctions is chaos for supply chains. Picture this: a factory has 99% of the parts it needs to build a car, but that last one, a tiny microchip, is now blocked by sanctions. Suddenly, the entire production line grinds to a halt. This isn't a hypothetical. It's a reality we've seen play out time and again. For example, when sanctions hit, companies that rely on imported raw materials or specialized components face an immediate crisis. Their suppliers are cut off, their shipping routes are blocked, and their inventory vanishes overnight. This leads to production shutdowns, soaring prices for consumers, and widespread uncertainty. Businesses are forced into a frantic scramble, trying to find any workaround possible, but the damage is often swift and severe, creating a ripple effect that can be felt across the entire economy. Faced with this kind of pressure, sanctioned countries are forced to get creative and look inward. This is where the strategy of import substitution comes into play. Essentially, it's a national project to start producing goods at home that were previously imported. The government might pour money into developing its own tech sector, offer huge subsidies to local manufacturers, and build up domestic industries from scratch. For instance, a country cut off from foreign agricultural products might invest heavily in its own farming and food processing capabilities to ensure food security. The goal is self-sufficiency. It is about reducing dependence on potentially hostile nations and building a more resilient economy that can withstand external shocks. It's a tough, expensive, and long-term process, but for a nation under sanctions, it's often seen as the only path to survival. But building everything from scratch is nearly impossible. So, alongside boosting domestic production, sanctioned countries desperately search for new friends and new trade routes. This is where we see a major reshuffling of global alliances. A country blocked from trading with the West might pivot and strengthen its economic ties with other nations in the East or the global South. We're seeing the emergence of new trade corridors designed specifically to bypass traditional sanction-enforcing networks. For example, think of new railway lines, shipping routes, or even digital payment systems created by a bloc of like-minded countries. These new partnerships aren't just about finding alternative suppliers. They're about building a parallel economic ecosystem, a club of nations that can trade freely with each other outside the reach of Western sanctions. This creates new centers of economic power and fundamentally changes the flow of global trade. So what's the long-term consequence of all this? We're heading towards what economists call global fragmentation, or a splinter net. Instead of one interconnected global economy, we could see the world break apart into competing economic blocs. Imagine one bloc centered around the US and its allies, with its own technology standards, supply chains, and financial systems, and another bloc centered around countries like China and Russia, with their own separate systems. This creates huge risks. Global efficiency, which has driven down prices for decades, could be lost. Companies might have to choose which bloc to operate in, creating what's called a decoupling of economies. This isn't just a political issue. It means less choice for consumers, higher costs for businesses, and a more unpredictable and potentially less stable world. The era of seamless globalization as we knew it might be coming to an end. And here is a critical point. The impact of sanctions often lasts long after they are officially lifted. Once a country has spent years and billions of dollars building its own domestic industries and forging new trade partnerships, it's not just going to abandon them overnight. Trust has been broken. Companies that switched suppliers are hesitant to go back to their old partners, fearing that sanctions could be reimposed at any time. The new trade routes, once established, become permanent fixtures of the global landscape. Essentially, sanctions force a permanent rewiring of economic relationships. They create a new normal where resilience and diversification are valued more than just pure cost efficiency. This long-lasting scar tissue on the global economy ensures that the trade patterns we see today will look very different from the ones we had just a decade ago. From a purely economic standpoint, this entire dynamic is a fascinating, if unsettling, case study in risk and adaptation. For decades, the dominant logic was efficiency. Companies built just-in-time supply chains that spanned the globe, all to shave a few cents off the cost of production. Sanctions have completely flipped that script. Now, the key word is resilience. It's no longer about finding the cheapest supplier. It's about finding the most reliable one, even if it costs more. This is pushing us towards a model of friendshoring, where countries prioritize trade with politically aligned nations, and nearshoring, where production is moved closer to home to reduce logistical risks. For businesses, this means a complete strategic overhaul. They have to map out their supply chains with geopolitical risk in mind and build in redundancies. For the global economy, it means a period of costly adjustment, but potentially a more stable, albeit less integrated, system in the long run. Looking ahead, the trend of using sanctions as a primary foreign policy tool is unlikely to go away. This means the fragmentation of the global economy will probably continue. We can expect to see countries investing even more heavily in strategic sectors like semiconductor manufacturing, renewable energy, and artificial intelligence to reduce their vulnerabilities. We'll also likely see the rise of alternative financial systems and digital currencies that operate outside the traditional US dollar-dominated framework. This isn't just about politics. It's a fundamental economic realignment. The future of global trade won't be a single open highway. It will be more like a network of regional roads with different rules, different standards, and different destinations. Navigating this new, complex world will be the single biggest challenge for businesses and policymakers for decades to come. In the end, economic sanctions are a powerful catalyst for change. They don't just punish a country. They force a fundamental reevaluation of economic strategy, not just for the target nation, but for everyone. They accelerate the shift from a world of hyperglobalization to one of strategic competition and regional blocs. Understanding this shift is key to understanding the future of our global economy. Thanks so much for watching. If you found this breakdown insightful, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our next deep dive. Let me know your thoughts in the comments below. See you next time.